Welcome to our lecture video. Today we are going to study beta, the capital asset pricing model, and the cost of equity. This topic is one of the most important bridges between finance theory and real business decisions. It helps us answer a simple but powerful question. What return should shareholders require when they invest in a company? Equity investors provide capital today, but the future is uncertain. Dividends may or may not be paid. Share prices may rise or fall. Business conditions may improve or deteriorate. Because equity holders are residual claimants, they are paid only after the firm satisfies its operating costs, taxes, reinvestment needs, and debt obligations. That uncertainty creates the need for a required return. But here is the key idea. Investors do not require compensation for every type of risk in the same way. Some risks can be diversified away by holding many assets. Other risks remain because they are connected to broad market conditions. Beta focuses on that second type of risk, systematic risk, and capital asset pricing model uses beta to estimate the return equity investors require for bearing that risk. By the end of this lecture, you should understand why beta matters, how capital asset pricing model connects risk to return, how the cost of equity is used, and where judgment is needed. Let's begin with the required return and the cost of equity. A required return is the return investors demand for committing capital to a risky asset. From the investor's perspective, it is the minimum expected return that makes the investment acceptable. From the firm's perspective, that same required return becomes a cost of capital. The cost of equity is the expected return required by shareholders. It is not like interest on debt. A company does not sign a contract promising shareholders a fixed return. Instead, the cost of equity is an opportunity cost. Shareholders could invest their money somewhere else in securities with similar risk. So, if a firm wants to attract or retain equity capital, it must offer an expected return that is competitive with those alternatives. This is especially important when firms use retained earnings. Managers may think, we are not borrowing money, so there is no financing cost. But retained earnings belong economically to shareholders. When the firm reinvests those earnings, it is using shareholder capital. That capital is not free. A project creates value only when its expected return is greater than the return shareholders require for the risk they are bearing. So the cost of equity becomes a benchmark for valuation, capital budgeting, performance evaluation, payout policy, and strategic decision-making. Let's now separate total risk from systematic risk. Total risk is the full uncertainty of a security's return. It includes everything that can affect the stock: company news, product success, management decisions, lawsuits, supply problems, changing customer preferences, and broad economic conditions. But diversified investors do not hold only one stock. They hold portfolios. When a portfolio contains many different securities, some firm-specific risks tend to offset each other. One company may have bad news while another has good news. One industry may weaken while another improves. This is the logic of diversification. Systematic risk is different. It is the risk connected to broad market forces. These are forces that affect many firms at the same time: economic growth, inflation expectations, interest rates, financial market conditions, recessions, and investor risk appetite. Diversification can reduce firm-specific risk, but it cannot eliminate systematic risk. That is why systematic risk is central in market-based valuation. Beta is designed to measure how sensitive a security is to market-wide movements. A high beta stock tends to move more strongly with broad market conditions. A low beta stock tends to be less sensitive to those conditions. So beta is not simply a measure of how volatile a stock is. It is a measure of how much market-related risk the stock adds to a diversified portfolio. Interpreting beta requires one important idea: Beta is relative to the market portfolio. The market itself is the reference point. A stock with market-level beta has systematic risk similar to the broad market. If the market risk premium is positive, investors require a return similar to the market's expected return. A stock with higher beta is more sensitive to market-wide movements. When the market environment improves, it may tend to respond more strongly. When market conditions weaken, it may also tend to suffer more. Because investors bear more systematic risk, they require a higher expected return. A stock with lower beta is less sensitive to market-wide movements. It still may be risky, but less of that risk is tied to the broad market. Therefore, its required return is typically lower than that of a higher beta stock, assuming the same market risk premium. Some assets may have little market exposure. Others may even move in the opposite direction of the market, providing hedging value. But be careful. Beta is not a guarantee. A high beta stock is not promised to rise whenever the market rises. A low beta stock is not immune to losses. Realized returns include company-specific news, surprises, and random shocks. Beta describes an average market sensitivity, not a mechanical prediction. We are now ready for the capital asset pricing model. Capital asset pricing model links required return to systematic risk. It says that the cost of equity depends on three major inputs: the risk-free rate, the equity beta, and the market risk premium. The risk-free rate represents the time value of money. In practice, analysts often use government securities as a proxy, while matching the currency and horizon of the cash flows as closely as possible. The market risk premium represents the extra expected return investors require for holding the market portfolio instead of a risk-free asset. In capital asset pricing model, this is the reward for bearing market risk. Beta tells us how much market risk the specific security or project has relative to the market. The economic interpretation is very clear. The required return includes compensation for the time value of money and compensation for systematic risk. So, when a firm has higher systematic risk, equity investors demand a higher expected return. But capital asset pricing model is not a machine where we blindly insert inputs and accept the output. Every input requires judgment. Analysts must choose an appropriate risk-free rate, estimate beta carefully, estimate the market risk premium, and then ask whether the final cost of equity makes economic sense. Capital asset pricing model is simple, but good application requires thoughtful analysis. The security market line is the visual representation of capital asset pricing model. On the graph, required return is shown on the vertical axis, and beta is shown on the horizontal axis. The line begins at the risk-free rate, and its slope reflects the market risk premium. The security market line teaches three important lessons. First, investors require compensation for systematic risk, not for firm-specific risk that can be diversified away. Second, in capital asset pricing model, the required risk premium rises in a straight-line relationship with beta. Third, a security with higher beta must offer a higher expected return to be fairly priced. This idea is useful not only for investors, but also for managers. If an investment's expected return is above the return required for its beta, it appears attractive from a risk-return perspective. If the expected return is below the required return, it does not adequately compensate investors for the systematic risk. In corporate finance, we use the same logic when evaluating projects. The question is not simply, is the expected return positive? The better question is the expected return high enough for the risk? This distinction is essential. A risky project may look exciting, but if it fails to earn more than its required return, it can destroy value. A safer project may look modest, but if it earns more than its required return, it can create value. How do analysts estimate beta in practice? For publicly traded firms, Beta is often estimated using historical return data. The common approach is to study how the firm's returns have moved relative to the market's returns over time. In that statistical relationship, beta is the slope. It measures how strongly the firm's return has tended to move when the market return changes. But the word tended is important. Beta is a statistical estimate, not an exact law of nature. The firm's stock return is affected by market movements, but also by company-specific news and other influences. That is why beta estimates can be noisy. Several choices affect the result. The analyst must choose a market index to represent the market portfolio. The analyst must choose the return interval, such as daily, weekly, or monthly returns. The analyst must choose an estimation window. The analyst must consider whether the firm's business mix or capital structure has changed. Unusual events can also distort the estimate. Fin trading can create additional problems. Because of these issues, analysts often compare a firm's beta with the betas of similar companies. For private firms, divisions, or projects without traded equity, comparable public firms can provide useful evidence. But again, judgment is necessary. Beta is an estimate to be interpreted, not a number to be worshipped. Equity beta reflects both business risk and financial leverage. Business risk comes from the firm's underlying operations before considering how those operations are financed. It depends on the nature of the business. Some firms have revenues that are highly sensitive to the economy. Some face strong pricing pressure. Some have high fixed costs, which makes profits more sensitive to changes in sales. Others face regulation, technology risk, commodity price exposure, or exchange rate exposure. These operating characteristics affect the risk of the firm's assets. Financial leverage is the use of debt financing. Debt has priority over equity. Interest and principal payments must be paid before shareholders receive residual cash flows. When a firm uses more debt, the same business risk is concentrated on a smaller equity base. As a result, equity becomes riskier and equity beta generally rises. This is why two firms in the same industry can have different equity betas. Their underlying businesses may be similar, but their capital structures may differ. Managers must interpret beta carefully. A high equity beta may reflect risky operations, high leverage, or both. A low equity beta may reflect stable operations, conservative financing, or both. The cost of equity is the return required on levered equity. It is not a pure measure of operating risk by itself. This distinction matters whenever managers value firms, analyze projects, or compare companies. Now let us think about using capital asset pricing model in managerial decisions. The capital asset pricing model cost of equity is most useful when managers need a disciplined benchmark for risky equity cash flows. It appears in valuation, capital budgeting, performance measurement, merger analysis, share repurchase analysis, and capital structure decisions. A practical process begins with identifying the cash flows being valued. Then the analyst estimates the systematic risk of those cash flows. Next, the analyst chooses a risk-free rate consistent with the currency and horizon of the cash flows. Then the analyst estimates the market risk premium and applies capital asset pricing model to estimate the required return on equity. Finally, the expected return or valuation result is compared with the required return. The most important rule is matching. The discount rate must match the risk of the cash flows. If a project has systematic risk similar to the firm's existing equity, the firm's equity beta may be a useful input. But if the project has very different risk, the firm should not automatically use its own beta. Managers should not increase discount rates simply because a project feels uncertain. The adjustment should reflect whether the uncertainty is systematic and whether diversified investors require compensation for bearing it. Diversifiable risks should usually be handled through cash flow forecasts, scenario analysis, or risk management. not by mechanically adding extra premiums to the discount rate. Good finance requires disciplined judgment. Before we finish, let us discuss the limitations of beta and capital asset pricing model. Capital asset pricing model is useful because it is clear, intuitive, and widely understood. It forces us to connect required return to systematic risk rather than vague impressions of risk. But it has limitations. Beta is estimated with error. Historical betas can change depending on the sample period, return frequency, market index, and unusual events. The true market portfolio is not directly observable. Analysts use broad indexes as proxies, but different proxies can lead to different estimates. The market risk premium must also be estimated. Expected market returns are not directly observable, so analysts may use historical evidence, forward-looking estimates, surveys, or a combination of methods. Capital asset pricing model also focuses on market risk as the main priced risk factor. In practice, returns may be related to other factors as well. These limitations do not make capital asset pricing model useless. They mean it should be applied with judgment, sensitivity analysis, and a clear understanding of the economics behind the inputs. So here's the key decision rule. Ask, what return would diversified equity investors require for bearing the systematic risk of these cash flows? That answer is not automatically the firm's historical return, accounting return, dividend yield, or cost of debt. It depends on the risk-free rate, the market risk premium, and the beta of the cash flows. Thank you for watching. I hope this lecture helped you understand beta, capital asset pricing model, and the cost of equity. I will see you in the next video.